Gold has given investors a compounded annual return of 10.2% over the past couple of years. This has happened despite macroeconomic developments that were negative for gold, such as the US Fed hiking interest rates by 525 basis points and the dollar index moving up by around 13%. According to Vikram Dhawan, fund manager commodities at Nippon India Mutual Fund, the factor that really propelled gold prices up was heavy buying by central banks as they look to diversify their assets. In the near future, what could move prices further up from current levels is investment demand, if it were to come in. And that would happen if the global economy were to slow down considerably from current levels. Watch this interview to learn more about gold's prospects and also to learn about the investment instrument you should choose this Dhanteras. Good morning, Mr. Dhawan, and welcome to our show.
Good morning. Thanks for inviting me.
November 10th is Dhanteras, and a lot of people in India will be purchasing gold on that day. So we thought this was a very good occasion to discuss both gold's prospects and the instruments that people should use when buying gold. My first question to you is, the Nifty Gold Bees, the exchange traded fund run by your fund house, has given a return of 19.57% over the past year. Even the year-to-date return has been sound at 9.1%. So what accounts for this stupendous return from gold over the past year?
So we have to look at this return against a backdrop which is extremely hostile for gold. Both the macro and the micros have been extremely hostile for gold in the past 2 years. Just to share a few statistics, in past 2 years, the interest rates in the US have gone up by about over 500 basis points or 5%. The dollar index has been up close to about 13% in the past 2 years. Yes. And if you talk about the investment flows, in past 2 years, roughly about 600 to 800 tons have come out of ETFs globally. Also, if you look at the open interest in gold in both COMEX and the exchanges across the world, it is down at least by 20 to 30%. So against this backdrop, and also add to it an extremely risk-on environment. I mean, it is off and on been a risk-on environment. The risk assets, especially equities, have been the flavor for the past few quarters at least, if not past 2 years. So against that backdrop, gold has been able to perform quite well. And last financial year, gold was amongst the best performing assets. Why it has happened is because of few reasons. Despite not finding much traction from the investors, ETF flows and outflows can be a bit it may not give you the entire picture, because traditional form of investment into gold is in form of coins and bars. So while we saw ETF flows being negative for the past 2 years, which was a post-pandemic year. So typically it was the pandemic hedge which was being unwound. But we have seen steady demand in the physical market throughout this period. It's not been spectacular, but considering the volatility in the gold prices and the high elevated prices, the demand has been steady. But most importantly, the biggest driver of gold prices in the past 2 years have been the central bank buying. Now, last calendar year, central bank bought close to about 1,300 tons, which is a 55-year high. I mean, typically they buy only 400 to 500 tons annually. So you can imagine the quantum of buying that we saw last year. This year, in first 3 quarters, they've already bought close to about 800 tons, which is again at least a 20-year high. So, all these factors, steady physical market despite hostile macros and micros, and central bank buying, which has been extremely, outsized, as I would like to say. It's been at least multi-decades high. this has been supporting the prices and driving the prices.
So, what is behind this humongous buying by central banks?
So central banks buying, this is not the first time that they have bought, huge quantities. If you see the statistics in 2017-18, I mean, gold prices, the long term or the mid term bottom happened in 2015 and 16, and the rally post that was again initiated by the outsized central bank buying. And at that point of time, the Chinese and the Russian central banks were at the forefront of buying gold for their for their reserves. I mean, that time there was no talk about COVID or geopolitical issues or de-dollarization, which has become such a big topic right now. So central banks have had these phases where they have bought, but one obviously one can assume that that buying was more strategic because if you remember during those times there was a lot of tensions as far as the trade between the two three China and US was concerned, the Trump years. And they were buying gold for strategic reasons because in case and obviously fast forward to now, the de-dollarization has got obviously one of the things that is driving the gold demand right now is that the on an average gold hold the central banks across the world hold roughly about 60% of their assets in dollars. And what they have seen post-pandemic is that a lot of volatility in the U.S. Treasuries. And what has not helped the case is that central banks have not been able to give proper guidance on the trajectory of inflation or interest rates, which has created a lot of volatility in the assets of central banks, and they don't like volatility. And secondly, if you talk about the post Ukraine war era and post the Middle East, what we are seeing right now, this will only accelerate the de-dollarization. But obviously, these are something which will happen over many years. It's not going to happen overnight because somebody like China has got $3 trillion worth of reserve. India has got more than $500 billion of reserve. So it's not going to exchange hands overnight. But and also not all of it will go into gold. But yes, if you had to move away from US dollar, then you would be looking at you would already be holding euros and the Swiss francs and most of these Japanese yen, but you would now be looking into currencies like the Chinese yuan, and obviously gold also will be one of the things which the central banks will be looking at. So I think all these factors put together are driving the demand for gold. Also, what you have to appreciate is that in absence any bilateral trade, in absence of dollar or euro or yen, which are which have global spot markets, liquid spot markets. For instance, you must have heard the our Russian counterparts complaining that they have now huge amount of rupees which they don't know what to do with. And similar situation will happen in every bilateral trade because unless it is a balanced trade, you will have these mismatches of asset liabilities in various currencies. And currencies like yuan or rupee or ruble, they don't have an official spot market globally. So then at some point of time, you would need to create some mechanism which is backed by some collateral or some sort of process. And gold can be one of the things which can play a role. Again, it's still speculation what's going to happen, but gold is definitely one of the ways where this asset liability mismatch can be, sort of worked around with.
So you have given us two reasons for gold's performance. One was central bank buying, the trend towards de-dollarization, and you said that physical gold buying has also held steady. Are there any other factors that you'd like to focus on, like say the geopolitical situation, things like that? Has that also played a part?
So gold, whether it is a financial crisis or a geopolitical crisis, gold will always, perform well because of its traits of liquidity. And I mean, liquidity in terms that, not many people may be aware that in terms of liquidity, gold is amongst the top five if not top three securities. I mean, starting with the U.S. Treasuries and the S&P 500 or similar indices, gold is very close to that. And so you can imagine the liquidity aspect plays a very important role. It doesn't have any credit risk involved, and it can be changed into hard cash or immediately anywhere in the world. And there is no erosion of value also, A gold bar is a gold bar, whether it is in India or Turkey or, South Africa. So which not many securities can boast of. So, that is why whenever there is a financial crisis, whenever there is a geopolitical event, there is a flight to gold, which adds a risk premium on gold. But again, these may be a bit fickle, as we have seen in case of COVID, that the prices shot up, and when COVID was, brought under control, then the risk premium evaporated. So I think the for the investor it can be very confusing. But I think if you think about it, if you are an investor or an individual who believes in wealth creation through diversification, and if you had gold in your portfolio, so you may be a lot happier than those investors who don't are not holding any hedges or anything similar, gold or anything similar to that, which can protect you against any further deterioration in the geopolitical scenario which is unraveling in the Middle East. And not to mention that we also have another war going between Russia and Ukraine.
From here onwards, after this very steep run up, how do you expect gold to perform? And what are some of the factors that could drive prices upward?
So I think gold, if you look at the 3-4 pillars of gold prices which it stands on, one is obviously central bank buying, which is very important. The second is the physical demand, the jewelry demand, in which India and China are they account for roughly 50% of the global demand. So what kind of buying that we see from India and China? I mean, again, we are in the middle of the festive season in India. It remains to be seen if the higher prices create a dent in the demand, or actually because of geopolitics. And obviously, we are becoming more affluent. The country is becoming, the economy is doing a lot better than most of the world. Will we see higher demand or lower demand, as the case may be? Then you have the investor demand. Investor demand is divided into two parts through the ETFs. Now, investors in ETFs, gold ETFs, are typically those investors who already mostly have an existing portfolio of equity, debt, or asset or capital markets. They are already vested into capital markets. So for them, gold becomes a diversification. And then there's another aspect of investment into gold, which is coins and bars. And last but not the least is the event risk, as I mentioned, geopolitics and financial crisis. So these are the four factors that we would drive the gold prices ahead. We would need at least two of these factors firing for gold. If we see the outsized or historic buying by central banks continue, then it's a big positive for gold. If we see the demand remaining steady despite higher prices, that again will provide a floor or support to gold prices. And also, it's worth appreciating and noting that ETF holdings across the world are almost at 3 to 4 year low, almost at the pre-pandemic level. So nobody is overweight. I mean, on an aggregate basis, investors are not overweight on gold. So if there is any behavioral change in investors in the ETF, as I mentioned, the investment into bars and coins continues at steady rate. But if the investors into the capital markets want to diversify, could be a material slowdown in the global economy. I mean, come to think of it, if it's US and it's India, very few pockets in the world which are performing well, in terms of growth. So less than third of the world is in good health as far as the economies are concerned. So so if there is a material slowdown, which may or may not happen, but if it happens, and if it spills into the capital markets in terms of volatility, there will be demand for hedging, diversification. So I think all these factors will play a very important role going forward as far as gold is concerned. And obviously, nobody can predict which next geopolitical or financial event is around the corner. So, and that is why everybody would like to hold some amount of gold in their portfolio, because this is something that we cannot predict. Nobody could predicted COVID. Nobody predicted the Ukraine war or the Middle East conflict. So that's the uncertainty. Will also drive a little bit of demand for gold.
Now we'll talk about the investing in gold, but on Dhanteras Day, a lot of people will also buy gold jewelry. Would you have some advice for such buyers? How do they ensure purity? What are some of the other things to keep in mind when you are buying jewelry?
So first of all, jewelry is not an investment. I'm not saying you should not buy jewelry, because obviously that is one of the most beautiful presentation of gold ornament and jewelry, and what jewelry can do. A gold ETF unit sitting in your demat account will never look that beautiful. So I think there is a demand for jewelry, and it is a very cultural thing. And it's not only in India. If you look at host of countries in Asia, Middle East, and even in the Western world also, gold is a very important part of their culture. So this buying is irrespective of what the view on price is, or portfolio diversification. But again, it is not an investment, because or rather it's not a very efficient way to invest into gold, because if at all, God forbid, you have to convert this jewelry into cash, then there will be a lot of the impact cost can be very high. A ballpark figure, very approximately, if you convert jewelry into gold, then there could be anywhere between 10 to 30% impact cost. So I think use jewelry to feel good and to celebrate, but don't put it under your portfolio. As far as buying jewelry is concerned, I think the investors should be aware about what gold rates are being charged, and thanks to social media, you can get those gold rates. What is the basis for calculating the value of the jewelry? Make sure that you are aware what rate they have, the jeweler is taking. Obviously, it will not be exactly what you're seeing in MCX or National Stock Exchange or any of the apps or Bloomberg, but it should not be too far away also. You don't want to create another layer of impact cost in your buying jewelry. Also, I think hallmarking has become very important. The World Gold Council, along with the various bullion association, in which the IBJA is one of them, Indian Jewelers and Bullion Association, and the other association across the country, they have been really expediting the hallmarking into the gold jewelry as far as possible. Buy hallmark jewelry. Now, what hallmark jewelry means essentially is that it is certified. You get a certificate with it, so it's a lot easier. It's like if you're holding a gold bar or a gold coin or a piece of gold jewelry which is not backed by paper, then it is your word against the word of the buyer. But if you are holding a certificate and a hallmark certificate along with it, then it will ensure that you have you are not at the mercy of the buyer when you intend to sell it. God forbid, for any reason. For happy reason, obviously you will sell, because people do exchange their jewelry for bigger and better stuff. So that's why hallmarking is very important.
Now, from an investment point of view, why should people hold gold in their portfolio? Could you dwell on it at some length?
So I think compounding has been one of the biggest factor in wealth creation for investors across the world, across the asset classes. And if you believe that, you can always be a good trader also. I mean, you can time the market. That is also one aspect. Not many people have that quality, but unless you are very good in timing the market, the only option for you is to spend more time in the market, as they say, and allow the compounding to create wealth for you. Now, how does compounding work best? Compounding works best if your risk-weighted returns are, decent, or if they are significant. The risk-weighted return means that your portfolio is generating steady returns with minimum volatility. I mean, there's no point having a portfolio which is up by 40% one year and then 30% down next year, because then you are not sure of the rate of compounding. So if you believe in compounding, then a multi-asset approach is one of the ways to ensure that you are able to participate in all the asset classes in the long-term trajectory of all the asset classes. Equity will have a long-term trajectory, bonds will have a long-term trajectory in terms of returns, gold and commodities will have a long-term, trajectory in terms of returns. So in a multi-asset approach, what happens is that you are not only able to participate in the long-term trajectory of all these assets, but more often than not, most of the frontline assets are either poorly correlated or they have a negative correlation amongst each other, which means that over a given period of time, the volatility of the portfolio should be at least a lot lower than the frontline market that you are investing in. So I think if you believe in wealth creation through compounding, through diversification, then gold is one of the solutions that you can use in your portfolio, and it ticks all the boxes as I mentioned earlier, that in terms of liquidity, in terms of no credit risk, in terms of its fungibility with the cash and negative correlation with the various assets, and its tendencies to perform well in times of when there's a financial crisis or geopolitical events. All that thing, gold ticks a lot of boxes as a diversifier to a portfolio. So that's the main reason why investors should look at gold into their portfolio.
How much should a retail investor allocate to gold?
So I think instead of giving a number, I mean, obviously there was a study done by World Gold Council, and it's available on their website. They had come out with the figure that a typical Indian pension portfolio, um, you know, if your gold allocation is between 5 to 15%, that is the ideal range. What they were trying to say that less than 5% and more than 15% is suboptimal as far as allocation to portfolio is concerned. But I think there are a couple of other things that investors need to keep in mind, that what is their objective? Are they using gold for tactical play? Then I think mutual fund is not the place for tactical play, then it is trading. If they're using gold for diversification, then I think that is where the mutual fund environment comes in handy. And also, if their portfolio is skewed more towards fixed income, then typically what happens is that bond tends to underperform where there is currency volatility, when there are geopolitical issues, when the oil prices are higher, and that is when gold comes in very handy as a hedge or the diversifier, as the case may be. And also, then you can use gold more to enhance the returns of your portfolio, the aggregate returns of your portfolio, aggregate risk-weighted returns of your portfolio. If your portfolio is skewed more towards equity, then gold becomes an outright hedge, in the sense that if the volatility in equity markets is increases, and there is a study, again the study referring to a study done by World Gold Council, in which they have, it is again available on their website, they have mentioned very clearly that the historic data suggests that whenever risk assets like equity have fallen steeply, or the volatility is at at a historic high, which means if the equity prices fall or remain volatile in multiples of 1, 2, or 3 standard deviations, then gold has performed its best. Also, in terms in recessions, gold has been, as per the historical data, gold has been the best performing commodity in most recessions. So, all these factors should be taken into consideration before deciding how much to allocate into your portfolio.
Now we'll talk about the products that you can use for investing in gold. So why use gold ETFs? What are their pros and cons?
So gold ETFs, have been one of the best innovations of the financial sector, and there are a few reasons for it. The liquidity in the gold units, which are listed on the exchange, is significantly higher than the liquidity in the physical market. I mean, you can always do a test in buying and selling 1 gram of gold physically and making the same trade in an ETF. You will realize that the difference in impact cost is fairly significant, which again is a boon for the retail investors, because retail investors will buy typically buy small quantities, so they are not affected by the impact cost which they would have incurred if they were investing the same quantities into the physical market. Secondly, the mandate of the gold ETF in India is that it has to be backed by physical gold bars of the highest quality. As per the SEBI guidelines, the bars have to be of LBMA good delivery. LBMA is the London Bullion Market Association, which is the gold standard for gold bars. I mean, apologize the cliche, but it is the gold standard of gold bars in the world, which ensures that every unit of ETF that you're holding is backed by gold bars, which comply to the highest standards in terms of purity, in terms of weight, in terms of source, etc. I think the most important aspect for investors, especially those investors who believe in diversification and compounding and wealth creation through multi-asset approach, it's very important for them to appreciate that this is one product which is fully regulated, and I don't need to tell that the SEBI regulations there in SEBI regulation the interest of the investor is of the highest priority. So they can get benefit of all these features. At the same time, their interests will be protected by the regulations. So all these factors make gold ETF a very compelling choice for the investors.
And sovereign gold bonds have also become very popular in recent times. So, what are their pros and cons?
So I think first of all, India should not have a sovereign bond because these are all panic bonds. I mean, we have seen Turkey and some African countries issue these bonds, to tide over, short-term asset liability mismatches. We are not in any sort of distress, if you really ask me. Secondly, if the purpose of sovereign gold bond is to reduce the consumption or import of physical gold into the country,
yes,
that is something that remains to be seen because both the situations in which if RBI is hedging or not hedging are pretty precarious, because if they are not hedging, then as you mentioned, gold gave double-digit returns in the last 1 year. So that would have been the cost of raising money. I mean, you can raise same amount of money at 1/3 the cost in G-Secs. And if they are actually hedging it against by buying physical gold, then the overall consumption of the country doesn't change, the import of gold into the country. I mean, they may be buying and keeping it overseas, that's a different reason, but the overall physical consumption doesn't change. So I think it needs to have a relook from the policy point of view, because so much has been done for them, the interest being provided, the tax-free features that it comes with. So that is one thing which I think needs to be discussed and analyzed, whether do we need gold bonds from the macro perspective of country. Things may be different in 2015, but when they were started, but things are very different right now. So I think that's my view about gold bonds. But having said that, yes, they have their own features. They come with an interest. But again, since there is no participation from the institutions like mutual funds into the sovereign gold bond space, the liquidity is very limited, which means that the impact cost can be significantly higher. And I've heard it is sometimes as bad or even worse than the impact cost as in the physical market. So it will not serve a purpose if you're using it for a portfolio diversification, because as I mentioned, in terms of some sort of an event happening, a black swan event happening, and you may need the reason why you would invest in gold is because if you need cash that time, you may be able to sell your ETF units at the click of the button, which is so much convenient. So if you're not able to offload your gold at the prevailing price or with a higher impact cost, then it defeats the purpose, because the reason why people like gold across the world, especially central banks, is because of the liquidity. So I think it has its features, sovereign gold bond, but there are liquidity issues which still persist.
So do not buy sovereign gold bonds unless you can hold them for the entire tenure of 8 years. Okay.
That's correct, yes.
Currently, we have about 22 ETFs in the market. How does one select which ETF to go for? What criteria should one apply during selection?
Liquidity is a very important aspect. As I mentioned, you want your gold to be as liquid as possible. I mean, the reason why Indians love gold is because whenever they need cash, it can be converted into hard cash, at the corner shop or the shop beyond that. So liquidity is of prime importance. Before you select the ETF, you don't want to pay any additional impact cost that will defeat the purpose. Secondly, obviously, whilst these SEBI regulations are fairly cut and dry and there are no variations amongst what each fund house can do in terms of features are concerned. But I think, you'll also have to see, it takes, whether it is an ETF or an active fund, it takes a while of experience to make it, get things right and better. You have to see the experience of the fund house and what is their commitment, to this particular asset class. And obviously, the size also matters because whether it is gold ETF or a small cap fund or a mid cap fund, unless they attain a certain size, it is something that is something which is not very the investors need to be wary of. So I think the size, the liquidity, the experience of the fund house, these three things are very important.
As an investor, what parameter do I exactly look at to know whether whose ETF is more liquid?
So the data is available at the stock exchange. You can always ask your brokers or your wealth partners to get that data for you.
The turnover
The
data,
data is,
volumes.
yes, the turnover, yes, the liquidity data. I mean, you as not only gold, for every stock and every commodity, the data is available in various exchanges. You can always see that, what kind of liquidity or what kind of turnover each counter has, and then you can take a decision.
Is
You don't want to
tracking
be, sorry, you don't want to be, investing in any sort of counter. Let's leave aside gold ETF, any counter which is not liquid, because then coming out of it can create a significant impact cost.
Is tracking error a significant parameter to be used when selecting a gold ETF?
So what we have seen is that across the world, the top two or top three funds, I mean, let's go outside India. Let's talk about the top three fund in the US or Europe. More often than not, the top three funds, top three gold ETFs, do not have the lowest tracking error, because liquidity always, because see, here you're talking about tracking errors which will be in basis points. I mean, it is very unless something is fundamentally wrong with the gold market of that country or with that fund, or if there is a COVID-like situation where the supply chains were completely jammed, there was no gold coming in, coming out. Unless you have a situation like that, or a black swan event where there is run for cash or run for gold, if you leave that aside, typically the tracking errors of all the gold ETFs across the world will not vary that significantly. So, but the kind of expenses which you may incur in impact cost will always be a lot higher than the tracking error. That has been the experience of the investors. So if you invest into any fund, not just gold fund, with any ETF, you would also like to, because it's again an exchange traded product. You can't go approach the fund house directly unless you are investing into gold saving funds. That there again is something which the investors should look into it. There is something known as a gold fund of fund or a gold saving funds where investors can come directly to the fund houses, and there they don't have to, they don't need a demat account because it's not exchange listed. So I think these factors have to be kept in mind, before deciding which fund to invest into. But I think the most important part, as I mentioned, in gold is liquidity. So impact cost is, and liquidity is a bigger plus than tracking error.
Thank you, Mr. Dhawan. It has been a pleasure speaking to you. I'm sure this interaction will be very useful to buyers just on the eve of Dhanteras. Thank you and have a nice day.
Thank you very much. And thanks for inviting me. Thanks a lot.
Bye-bye.